Rhythm Desai, Managing Director of Morgan Stanley, joins us. Rhythm, good morning. Thank you for joining us. I'm glad you're joining us when things are looking slightly shaky and you can easily guide us what our viewers should do. It will be a difficult day of trade.
Yeah, well, first let me congratulate ET Now on their anniversary. Yeah, indeed, it's going to be a tough morning of trade. I still think that India is actually a better house in a relatively bad neighborhood. So I think beyond this, India's story remains intact. I actually take away a bit of positive stuff this morning. I think the sell-off on the rupee that has been going on for the past few days and which is continuing this morning and may continue into the next few days is likely to trigger some policy action. So I think we'll get some concentrated policy action in the next 15-20 days to respond to the rupee, whether it's in the form of FDI limits, whether it's in the form of further fiscal consolidation. I think the government will seriously look at taking some strong measures to revive the confidence in the INR. And that will actually only further help the cause of equity. So I don't think this is as bad for the equity markets. I don't think the equity markets are going to get that perturbed. But yes, the currency is under stress. Now, at the end of the day, remember, if this currency fall is happening across the world and it's not peculiar to India, then it is not just an Indian problem. And then actually, the currency helps earnings. And you will find that analysts will have to come back and raise their earnings forecast. If commodity prices are falling simultaneously as the dollar is rising, it does not actually bring inflation to our doorstep. So beyond this near-term volatility, which obviously is unnerving for corporate India and for investors, there are a few positive takeaways here for us. So I'm actually, if the market is going to correct a little bit, I think it just becomes a stronger buy.
But the fact that US economy has gained momentum and according to US Fed, it will gain more momentum. Does that optically weaken case for emerging market equities? Because the big thesis was US economy was in doldrum. Emerging market is where all the growth is. Go and buy into emerging market equities.
Well, in part, Nikunj, that's what the market has been doing for the past year, right? I mean, if you look at EPS forecasts in the developed world, they are like this. Or rather, this is the EPS performance. If you look at EPS performance in EM, they are like this. EM markets are like this. DM markets are like this. So the markets are already telling you that the EPS is going to go up. The markets have seen this coming for a while. In fact, the market saw the Fed announcement yesterday. No doubt, it turned out to be a little bit more hawkish than what we were expecting. But it had seen it coming. So, it started correcting a little while ago. So the markets are anticipating these changes. The changes are likely to be more gradual, if anything. We're going to see this unwind happen over a period of 9 months. There's a bit more clarity on the trigger points, i.e. unemployment rate of 7%. So we have some guidance from the Fed as to what will drive their unwinding program.
I guess broadly, money has moved out of emerging market equities, emerging market debt and emerging market currency. But once the dust settles down, eventually it will. Do you think Indian markets will stand out and they will start outperforming in a relative manner? Right now, it's a synchronized sell-off, but eventually will India stand out?
Yeah, in fact, Nikunj, in local currency terms, equities in India have already outperformed emerging markets over the past month. So the market is already telling us how it's going to differentiate. It's largely the currency that has caused, slight underperformance of Indian equities relative to EM. So in most part, this is an EM thing. And it's a fairly large adjustment that has to happen in the EM world because it's been a big beneficiary of the liquidity that has come out of the US over the past 3 or 4 years. So to make no mistake, there's been massive capital inflow into emerging markets, particularly emerging market fixed income, not so much equities, and that adjustment has to happen. So I think we're seeing that adjustment already take place and it is producing the volatility that we're seeing on the screens right now.
Rhythm, you just talked about it being a buy on dips market. What is one buy? That's the question.
No, I think, so let me just outline the story here. I think India has got a policy fix which has been underway since approximately the middle of last year. It has resulted in a considerably lower fiscal deficit than what most people were forecasting. So we've achieved fiscal consolidation. There have been other reforms that have happened, but the primary thing that has happened, which is of interest to me, is fiscal consolidation. We've seen the government's balance sheet shift away from consumption to investments. To a certain extent, the investment cycle, at least on the government side, has resumed. It is unlikely to start on the private side as yet, but at least the government side has resumed. So this is not a story a lot of emerging markets can tell us right now. A lot of EMs have their own structural issues and they are not actually adjusting. India is. So the policy fix in India is good. Inflation has peaked and some inflation may come back because of the pointed depreciation in the currency. But as the dust settles down, I think things may not look that bad because commodity prices may have also come down concurrently. So, a little bit of inflation may come back, a little bit of hardening of yields will happen, but, the big picture story is that the fiscal deficit is a lot lower and that was what was fueling India's inflation. Together with that, the CAD will decline. So, India's biggest concern last year was twin deficit and that's declining at the margin. So, the macro story is certainly turning better. The micro story also in our view will turn better because, again, as, Nikunj was asking, when the dust settles, I think you will find that the earnings outlook will be slightly better. No doubt, some highly levered companies will take a hit and, those are not the stocks that we want to buy. But, earnings will look better. So, I think the equity story in India with valuations being where they are actually looks quite okay. Global liquidity is a little worse off, but I think it's actually quite okay. So,
right.
So going back to your question, what you buy the banks, I think you buy energy, where we're seeing a structural turnaround. I think you buy select discretionary stocks in autos and media. And you avoid stuff which is very rich in valuations. You buy reasonably valued growth stocks.
Right. Your big call is that earnings have bottomed out. Margin or pricing power is coming back. And it is now time, or we could be staring at a new earning upgrade cycle. Now that could be a brave call given the kind of macros we are working with, because your earnings estimate for FY14 clearly are the best on the street.
Yes, Nikunj, that's true. But I'll caveat this by saying that it's a steady improvement. It's not a V-shaped recovery that we're going to see. It'll be a steady improvement that will pan out quarter after quarter over the next 5 to 6 quarters. And certainly there are risks to the forecast that we're making. It's premised on 2 points. One is that the investment cycle has seen its worst, and the second is that the current account deficit will adjust faster than the fiscal deficit. We are fairly confident about these calls because of the policy action that has happened, and therefore in that context, earnings will actually see an upward trend, largely led by corporate margins. Now the key takeaway from the last 2 or 3 quarters of what I would describe as really bad earnings is that margins have actually expanded every single of these 3 quarters. So corporate margins are no longer falling. Top line growth is what slowed down and that's what's created the pressure on profits. And as that stabilizes, because we expect GDP growth to actually improve from here on, you'll find that earnings will actually, reflect it the story will reflect itself in earnings.
Rhythm, how big an irritant is the currency when it comes to the foreign money coming into the country?
No, it's certainly a problem. There are 2 problems in the currency situation. One is that there is approximately $200 billion of liability sitting on corporate balance sheets, and they take a pointed knock. And obviously, when the currency is in a free fall, foreign investors want it to stabilize before they actually commit more money. So even though they may be bullish on Indian equities on a relative basis, the currency is obviously having its impact on their decision making. So, the currency needs to stabilize before you find investors actually taking a fresh view on the situation.
Right. Rhythm, you've been pointing out that the biggest risk for Indian equities is the ownership. And the FI ownership in Indian equities is at an all-time high. Of late, if I look at the data, foreign institutional investors have turned net sellers. A. B. They've not made any money this year as far as dollar returns are concerned. So are these concerns and are these big concerns?
No, in the context of the QE tapering situation, the fact that foreign ownership was high and that foreign positioning in Indian stocks, as reflected in the derivatives market, was high, were 2 big risk factors when we entered the month of May. Now the positioning has leveled off, obviously, because the markets have come off. So in part it's to deal with the unwinding of foreign positions. And foreign ownership has also declined, but not a whole lot. I think foreign ownership is still high relative to history. And, I think when we last spoke, I pointed this out, that there is a 2% threshold, i.e. when FI flows are in excess of 2% of India's market cap, it's always led to a bit of a sell-off in the event of any risk off. So that's what exactly happened. When that ownership levels come off, I think the markets will look a lot better technically. But in the meanwhile, that is a risk for the markets and they have to absorb this.
Rhythm, highlight for us a recent note of yours outlining the impact of the rupee depreciation also hints towards how Bharti's earnings are going to be impacted. What about the others like Kanhaiya and Arcom? Because this entire sector has been somewhat moving in the last couple of trading sessions.
Yeah, the rupee impact is something that is a short-term concern, but the structural factors in telecom are getting a lot better. Pricing power is coming back. Competition is reducing, regulatory environment is getting better, the corruption scandals are behind us. So fundamentally the sector is a lot healthier than it has been in the last 4 or 5 years. So, so we are actually on a bottom-up basis quite constructive on the telecom sector.
You've also talked about as to how the elections and then again, spending actually coming back into the infrastructure space would benefit names like a GVK, GMR, Hindustan Construction as well. Is the timing right to buy into these stocks, or do you think the market is going to give us better opportunities?
No, we have not highlighted these stocks as buys because my prime concern is about leveraged stock companies. So I don't think it's the appropriate time to buy leverage. That time will come. Excuse me. If you look at the various factors that are leading to performance, the worst factor in the marketplace is beta, and that is thankfully beta is not generating performance, because when beta starts generating performance, you actually come to the end of the bull market. Beta is a factor that loses money all through the formation of a bull market. So it's losing money right now. I don't think you should pursue high beta stocks. Just because the market has gone down, that doesn't mean high beta stocks are going to come back. For investors, it pays to look at companies that are generating growth and stocks that are reasonably valued. Beta is not the way to buy stocks. So I would not pursue high beta, and certainly I think it's too early to buy leverage.
You just talked about as to how banks are looking attractive to you at this point in time. Are all asset quality concerns sort of in the price? And do you think earnings for the banking space per se have now bottomed out?
Two parts to this. The private sector banks, which I think are doing okay and may continue to do well. They manage their balance sheets well, and their earnings profile looks good. For the public sector banks, I think you have to be a lot more selective, because for some of them, the asset quality concerns are still not behind us. And the recent shifts in the rupee may create fresh concerns on some asset quality issues. So I think you have to be careful about the valuations in the PSU space. You just cannot buy them because they're cheap. Selectively, some of them look good, but not all of them. So you select stocks in the PSU space, the private sector looks a lot better.
Right, 124 points down for the Nifty, 121 points down for the Nifty, still no recovery in sight, and even after a gap down start, things are not really looking up. Rhythm, so correct me if my interpretation is wrong. What you are clearly communicating here is that the worst of local news flow is now behind us. Macro data incrementally will only improve, but the big risk for Indian equities in the second half of this year will largely be global.
Yes, and I think something that has still not emerged in the horizon is China, because Chinese growth is looking a little wobbly, and you want to keep a close watch on that. Indeed, that is one reason why the Fed also may have to be careful. Because if China's growth doesn't come back, then it actually puts a tax on global growth and it puts a tax on US growth. So the story that the Fed told us yesterday is that growth is coming back, we are not slipping into deflation, so it's time to unwind QE. The biggest risk to that story is that China starts to wobble, seriously. So I think that is a factor that needs to be borne in mind. So those are the two things that are of prime concern to India. I think the domestic factors which were overriding all concerns in 2011 and the first half of 2012 are certainly behind us.
So in 10 seconds, if you have to wrap your closing comments, you're of the view that it is time to buy into this decline, don't hide for cover and don't run.
Yeah, and buy growth at a reasonable price. Do your stock selection. It's a time I think it's a time where stock selection will be rewarded quite handsomely.